Canada's inflation rate just fell again, now down to 2.2%. And if you look below the surface, something very interesting is happening. Gasoline is plunging. Even grocery inflation is cooling. Rents are slowing. Mortgage payment inflation is about to roll over as we pass through the renewal wall. And meanwhile, the global economy is quietly walking into something we haven't talked about since the early 2000s, since the last time we saw a recession. Deflation risk. Yes, deflation, or at the very least, disinflation. Not tomorrow, but the seeds are being planted right now. Here's the paradox. In Canada, at least, core inflation is still pretty sticky, especially in services and insurance. But the Bank of Canada still isn't convinced that rates should fall fast. But over the next year, the story may flip. What if the real problem moving forward isn't high inflation anymore? What if it is prices falling, margins compressing, wages stagnating, and debt suddenly becoming more painful in real terms? Canada is at a crossroads of three forces right now. Number one is a cooling domestic economy with soft GDP, rising unemployment, and collapsing consumer demand. Number two is a global trade war that could push up the price of goods in the short term, but also cause demand destruction and leading to less demand for those products, pushing prices back down. You often see this with oil price shocks. And then finally, we have number three, a housing market facing its own deflationary pressure as rents and mortgage inflation start to normalize. And we just saw that the annualized pace of home building is down now 17% in October, which suggests that home building activity is likely to cool next year. This is a really good example of how deflation begets more deflation, right? The housing market cooled, house prices came down. Builders, the producers of this product, were disincentivized to bring more of that product on the market. And then that industry contracts, and that leads to layoffs. That leads to less demand for the materials that they use to produce houses, right? So lumber, the wages of tradespeople, et cetera, et cetera. And then those people now in turn are going out and spending less money because those businesses are making less money. Economist Michael Cantrow talks a lot about this. He created this roadmap for how the economy responds to changes in interest rates. And it's easiest understood with the acronym HOPE, which stands for Housing, Orders, Profits, and Employment. So number one is housing. Housing in Canada, we saw housing drop very quickly at the beginning of the interest rate hiking cycle. That rate hikes got priced in, prices dropped substantially. And then as a result, all of the people who were buying decks and renovating their houses and feeling rich because they had a whole bunch of equity stopped ordering things. That's the O in orders. And then Home Depot or, the contractors who delivered those orders to those homeowners made lower profits. And when you make lower profits, you start to cut jobs, which is how it leads to the unemployment side of things. And we're just getting to the unemployment part of that cycle right now. And historically, cyclical bottoms, recessionary bottoms, even stock market bottoms typically coincide with housing market bottom. And so if you zoom out, this whole thing, these three factors that I mentioned, cooling demand, the trade war, and the housing market, these are exactly how these disinflationary and sometimes deflationary cycles start. And I know a lot of people say, oh, we're going to see another round of inflation. The Bank of Canada has lost the plot. There's too much money in the economy, blah, blah, blah. And I mean, there are even really compelling visuals on this, like the 1970s. They have these two charts, right? So this chart here shows 1970s inflation in blue and the present day inflation in gold. And there's a pretty eerie, cyclical track. But the reality is there are so many new financial tools that central banks have. Plus they have renewed mandates, right? Like in the US, they have a dual mandate now, both stable inflation and full employment. But they also have quantitative easing, which they didn't have. I think Japan kind of came up with that in the 90s. And then the US started using it sort of for the first time, I think, either during the dot-com or '08. And so they have gotten away from just having that blunt tool of interest rates to solve the economy. So I'm not really of the opinion that we're going to see like this second wave of inflation. Honestly, I think that, a lot of people, and people smarter than me, people with, just different theses than what I have on the market, say that, we're going to see this resurrection of inflation and whatever. I just can't see a version of Canada's economy and now even the US economy with the trade war, with how much that's contracting industry in the US, where we don't have a recession within the next couple of quarters, like at least by the end of next year. I mean, Trump's basically made it clear that that's his like last resort to get the yield down. And so to me, like the economy that is going to get us lower yields on U.S. capital, U.S. Fed funds rate, it is the same thing that's what's going to happen in Canada, which is, we'll see demand destruction. We'll see unemployment continue to rise. People will have less money. The economy will contract. And with that, you see deflation. I just feel like if I were to guess right now, what is a more likely outcome? Maybe deflation is a bit extreme. Deflation is when prices are actually going down, which I feel like a lot of the time that I talk about this, people are like, how is inflation falling if prices are still going up? Inflation falling is called disinflation, which means that the rate at which things are increasing is just going down. And so the price is still going up. It's just going up more slowly than it was before. Disinflation is when prices of stuff is actually falling. Wikipedia actually has a pretty good graphic on it here that shows, inflation versus disinflation versus, again, negative inflation rate, which is deflation. So, if you go to the store and you see a TV on sale, that to me is disinflationary, right? House prices falling is deflationary. Rents falling is deflationary. Anyway, I'm going to break it all down in this video. I'm going to talk about what the new CPI numbers really mean, why the BOC might hesitate to cut, but will still be forced to, which components of inflation could go negative, and the number one scenario that would turn today's disinflation into a full-blown deflation by late 2026. Let's get into it. So the headline CPI for October 2025 came in at 2.2%, down from 2.4%. I would say, if you really look at the longer term, this is sort of a continuation of a long-term downtrend. The all items CPI is now almost exactly at the Bank of Canada's target zone. But here's the more interesting part. Gasoline is down 9.4% year over year. The month over month drop is almost 5%. This is driven by cheaper winter blends. So you see this happen every year, plus an oversupply of crude. This is a deflationary force. Grocery inflation is at 3.4%, but cooling, down from 4%. Month over month, it's down 0.6%, the biggest drop since 2020. Vegetables are outright deflationary. Processed foods are slowing sharply. Food is still elevated, but directionally, it is losing momentum. Now let's jump over to shelter, rents and shelter. That's probably the only two things in this basket of goods I'm actually qualified to talk about. Rent inflation is still high, but slowing. And if you just go, you just need to go and look at rents, or go to the rentals.ca or live.rent blog to check out their annual rent reports. And you can see that rents are falling pretty much across the country. Mortgage interest cost inflation is also poised to collapse in late 2025 or early 2026. Whenever we get to that point where more people are renewing mortgages at a lower rate than a higher rate, which I presented some analysis from the Bank of Canada in my last couple of videos on this. This is important because mortgage interest costs have been the number one driver of Canadian CPI for almost 3 years now. So they're the largest piece of CPI. Rent is comparably substantial in the inflation basket. But we're now at peak renewal stress. And this isn't to say that that pain is going away. It's just that the inflation reading of that pain is going to start getting less every month after this, which means that the base effect that has been pushing that up is going to flip soon and start pushing that down as a contributor to CPI. This is why I think you listen to the Bank of Canada talk about being comfortable letting CPI run hot or letting inflation run hot, or even talking about changing the neutral range or staying to the upper bound of the neutral range. I think that if I'm a central bank and I'm comfortable letting inflation run hot, this would tell me that I'm a central bank that's probably worried more about the downside risk to inflation or the downside risk of trade war, the deflationary risk of trade war, than the inflationary risk of trade. And the Bank of Canada has really been modeling and observing and forecasting for both the upside and downside scenarios of potential trade or potential continuation of the trade, which seems like the very likely outcome at this point. Jumping back to the StatCan report, insurance is still inflating. Home insurance is up 6.8%. I just got a home insurance renewal. I have my primary residence and a couple of rental properties, and I was absolutely shocked by the year-over-year increase in the insurance payment, premium payment. Home insurance is up almost 7%. Auto insurance is up almost or over 7%. And this is like, without getting too, political, like without politicizing this, I really think that this is an outcome of sort of your lax stance on crime, right? Like we've had a lot of petty crime, we've had a lot of violent crime, you get a lot of break-and-enters, a lot of auto thefts, right? Carjacking, break-and-enters happening all over the GTA. What if I'm an insurer and all of my customers' cars are getting stolen, all their houses are getting broken into? What am I going to do? I'm going to increase my rates because I'm getting more claims. So this is sort of a outcome of bad policy on the crime side of things. I know we've seen a little bit of bail reform proposed from the Carney side of things, although I'm not sure how much of this stuff actually ends up seeing its way all the way through. I think it remains to be proven on the execution side of things. And it seems like it's more, from my perspective, we're seeing more typical red team execution, despite my willingness to give Carney the benefit of the doubt at the beginning. It seems like the more in line with the Liberal track record of like sort of policy not actually getting there. I don't know whether or not that's a reflection of him or the party. I would say very much the same team. So if it was me, I'd probably be blaming the party. So inflation is sticky on insurance, but it's not enough to offset the disinflation that we're seeing in goods and energy. Now let's talk about the bigger elephant in the room, which is, why are economists even whispering the word deflation again? And a big piece from my perspective is that you're seeing deflation in China, and China is exporting deflation around the world, right? If their economy is deflating and they're able to continue producing goods at lower rates, and they're able to continue trading with people, then those goods that we're buying from China, and China is the biggest producer of goods in the world, are going to go down in cost, which means we're going to start seeing deflation get imported into places like Canada where we buy those goods. And why this is happening in China is very similar to why I think that this could happen in Canada. And it's those three macro variables that I mentioned that are all turning in the same direction again. Number one is the demand destruction, right? Canada's GDP is flat or negative. We already had one negative GDP quarter this year. Q3 or Q4 could also be negative. Households are tapped out. Canadian household indebtedness actually worsened in Q1 of 2025 after a slight period of deleveraging that looked a little promising from my perspective. Retail sales are starting to roll over. Job vacancies are collapsing, and unemployment is creeping up. And when demand collapses, prices eventually follow. Inflation is always a lagging indicator. This is why the central banks usually end up cutting when it's already too late, because they want to be able to come out and say, hey, look, we're going to do everything we can to fix this problem. But if they do it too early, then, consumers are irresponsible. And if they think the Fed's going to pivot, then they're going to go out and lever up and buy stuff because they're assuming that rates are going to drop and assets are going to run again, or inflation's going to run again. This is called the pivot paradox. The second factor is the housing renewal wall, right? To me, this is the biggest reason why inflation is about to drop sharply, and why I think the Bank of Canada is comfortable cutting with core where it is because over the past 2 years, mortgage interest cost inflation made up nearly 30 to 40% of the total CPI. But here's the key piece of this. We are now exactly at the peak of the renewal pain and the mortgage renewal window. Within 6 to 9 months, those comps start to fall out of the data. Mortgage inflation will drop unless rates come back up, which I just don't think is a likely scenario in the next year. I think towards the end of next year, end of 2026, you'll start seeing, yields probably come up as a result of all of the spending the Bank of Canada or the government of Canada is doing. but I think mortgage inflation is going to drop potentially hard. And this alone takes 70 to 100 basis points off of headline CPI. This is a massive shift. The second piece is that rent inflation is peaking, right? New lease rates are down or flat in most CMAs in Canada. Purpose-built rental supply is hitting multi-decade highs. Population growth is slowing due to new immigration caps. Rent inflation lags market rents by 6 to 12 months. So in 6 to 12 months, we're probably going to see rent inflation come out as a major part of the CPI. This slows in 2026, whether the Bank of Canada likes it or not. Now, the last piece, and this is where the analysis gets fun, is the trade war, right? We have a US-China trade war with Canada caught in the middle somehow. And we have a couple of competing forces. Okay. So number one is inflationary forces, tariffs, which the Bank of Canada has done some good research on potential pass-throughs to consumers in an inflationary fashion. And they've modeled out everything from facial tissues to pickles to lemon lime drinks. Because of the trade war, we're seeing supply chain reshoring in both Canada and the US, which means more expensive production. Rising transportation costs are evident as well, although starting to come down. On the other hand, you have your deflationary forces. You have slower global growth, collapsing demand, cheaper commodities during recessions. Firms are forced to discount goods to keep their sales volume up. And if you look back, I mean, 2018 being a good comp, 17, 18, not an exceptionally good economy. Trade wars are historically net deflationary unless domestic wages and demand are accelerating. Today, neither of those things are happening in Canada or the US. So the trade war raises the price of specific goods, but it lowers overall economic activity. And this tends to reduce CPI or inflation, not raise it. Now, why would the Bank of Canada still be scared to cut if inflation is down and trending down? Even as the data cools, the Bank of Canada is worried about, number one, sticky services inflation, insurance, telecom, health services. These don't fall in recessions as quickly. Number two is wage stickiness. Even if hiring slows, wage levels remain high due to labor scarcity in specific sectors. Number three is the Japan scenario. If they cut too early, inflation comes back. If they cut too late, they get deflation. And they're trying to avoid this scenario, going the return of that and following this 70s double wave of inflation. But I would say they're probably more trying to avoid deflation. Benjamin Tal says, if the Bank of Canada had to choose between inflation and a recession, they would choose a recession every time. I don't know if the Bank of Canada had to choose between inflation and deflation, if they would choose deflation every time. I think they've sort of made it clear that they would actually prefer to choose inflation, which tells me that they're probably more concerned about downside risk in Canada's economy than upside risk or running the economy too hot. And so they're kind of trying to walk this tightrope. And what matters most here is that the Bank of Canada reacts to core inflation, which takes out a lot of the volatile sectors of the CPI basket. And core is still around 3%. But it does seem to be losing momentum pretty fast. So will deflation become the bigger concern by late 2026? Let's break this down into the possibilities. Scenario number one here is a soft landing, right? I would say there's probably about a 1 in 3 chance of this happening. Inflation would glide to 2%. Rates would fall slowly, growth would stay weak, but positive. We wouldn't see a recession. This is sort of like the target outcome for the Bank of Canada. I would say this is the lowest likelihood, or probably, let's say like 30% chance. Scenario number two is the opposite, the bad scenario, what they're trying to avoid, which is that GDP contracts, unemployment rises to 8 or 9%, mortgage and rent inflation collapse, which we're already seeing. Goods start to deflate, CPI gets below the neutral range. Again, I don't necessarily see it being negative. I just think our monetary system is built in such that we'll always have some level of light inflation. But in this scenario, the Bank of Canada would be forced to cut aggressively to try and stimulate the economy. I would say this would have a probably equal likelihood. This is your hard landing scenario, right? I would say you probably got equal, if not, I think you have a little bit harder or a little bit more likelihood of a hard landing than a soft landing. And then there's sort of scenario 3, which I would say probably is the highest probability, which is the Bank of Canada tries to keep inflation in a neutral range, but they're comfortable with it being on the upper bound. This would be sort of like a stagnation or maybe even stagflation, depending on what inflation reading people are willing to give the, the inflation category. Like, is it just if it's above the neutral range or whatever? But this is where inflation stays sticky, higher end of the neutral range, maybe around 3%, 3.5%. Bank of Canada holds rates longer, higher for longer. The economy limps through 2026. Bond yields continue rising because the government's spending a ton of money, and you enter an era of fiscal dominance, which is basically where the Bank of Canada can't outdo the impact that the government is having. So the government's putting all this upward pressure on inflation by spending so much money. Again, we have record deficit on paper next year of $74 billion. Usually they like to spend a little bit more than they forecast for on paper. If that's stimulative to the economy, which the bond market is kind of telling us that it could be, then even if the Bank of Canada tries to cap inflation a little bit, the fiscal side, fiscal is government spending, monetary is the central bank, the fiscal side would dominate, or fiscal dominance would take place. This stagnation, I think that both the government and the central bank wants like this stagnation or stagflationary setup. I think the Bank of Canada won't tell us this, but they don't think a soft landing is possible. I think that they probably would be really aiming for a more stagnation or stagflation outcome, because it's just a realistic thing for us to get with the circumstances that we're facing right now. And this is not the good scenario. This is not the catastrophic scenario, right? Soft landing would be good. That would be their target. Catastrophic, I think, would be, huge recession, deflation, huge mess. You have to do emergency rate cuts. Somewhere in the middle is this sort of stagnation or stagflation, which again is what I think we're probably the most likely to end up with. Yeah, I'd say 40% probability of that, maybe 31, 35% chance of a recession, deflation, whatever's left, 25% chance of soft landing, maybe less, honestly, 20% chance of soft landing. But we're starting to see, this scenario, the market is starting to quietly price in on the equity side, crypto's falling, gold's retreating. You can kind of already see the signals, right? Energy prices are falling. There's a manufacturing recession globally. Freight rates are dropping. Consumer debt stress is piling up in both Canada and the US. Population growth is slowing. It's mostly a Canadian thing, although you're seeing, I recently did a video on international students contracting in Canada, and I saw there's a very similar situation happening. The housing market is frozen, turnover is freezing. You're starting to see discounts in the retail world, right? You go to a store, everything seems to be on sale. And so a year from now, the question might not be, did we beat inflation? It could actually be, did we overshoot and walk into deflation instead? And we're starting to get emergency rate cuts to stop the economy from falling. So what does this mean for Canadians? The good news is lower price growth, right? I think the era of prices of goods running away on Canadians is over. I'm not seeing that second wave of inflation like the 1970s. I think the monetary setup and the tools that central banks have are just totally different than they were back then. The bad news is job insecurity, right? And the real bad news is if we start seeing deflation, your debt becomes more expensive in real terms, right? One of the reasons the central banks like inflation a little bit and letting it run a little bit hot is you can stay at the upper end of the neutral range, and over a 10-year period, the difference between 2% and 3% inflation sustained over 10 years is a 10% increase in cumulative inflation, or 10% difference in cumulative inflation. And that's a 10% lower relative debt load on a heavily indebted economy, right? Canada has some of the highest debt to household income in the world. What does it mean for homeowners? For homeowners, I think Bank of Canada is going to continue trying to cut unless the Fed, the Canadian government spends tons of money and pushes inflation back up and they get trapped, which would mean that, again, if the Bank of Canada does have more runway to cut, renewals are going to get easier. Home price appreciation will slow. So for owners, this kind of sucks. For buyers, this could be a good thing, right? It could continue presenting opportunities. Buyers have been rewarded for being patient so far. I think this means that house prices will continue to fall. Deflation, and we've seen this deflation in the asset. Deflation tends to hit asset valuations first. We've seen this in house prices for the last 4 years. For renters in this kind of market, rent growth slows, right? We've seen this take place. A lot of people say, oh, my rents aren't going down. My landlord keeps jacking my rent up. Well, like, negotiate with your landlord if that's the case, or go find a cheaper unit, because rents are down like 10% on a year-over-year basis. If rent growth is slowing, it's often because vacancy is rising. That'll continue happening while we have record rental supply being delivered. But unemployment rises, employment becomes less stable. For investors, I would say equities tend to struggle in this like sort of deflationary period. Real estate is flat or down. You start to see people rotate back from equities into real estate. And I would say, like, as a host of Canada's #1 real estate podcast, we see people leaving the real estate trade and going into the equities trade all the time, right? Like, if the stock market's ripping, the viewership on our show, because we'd get people kind of who are real estate curious, doing the research, whatever, the viewership on our show goes away, it kind of comes down. And then if equities are doing shit, then basically people pile back in and start researching real estate again. So for me, the big takeaway here is pretty simple. Inflation is no longer the only risk. For the first time in over a decade, I think that Canada has to worry about the opposite: a slowing economy, falling energy, negative GDP, and a housing-driven deflation impulse. The Bank of Canada doesn't want to say the word deflation, although they did use it in a couple of reports when they were analyzing upside and downside scenarios of inflation versus deflation as an end result of the trade war. But I think the data is starting to whisper this as much of a risk of inflationary upside to trade war, because the way that we're seeing trade war materialize in Canada is jobs being lost, plants being closed, companies leaving and going to the US, et cetera. That's deflationary. That's not inflationary. Everybody's saying we're going to see a second wave of inflation in Canada. Show me the data. I don't know what data actually points to a second wave of inflation in Canada, like the 1970s thing. In the US, maybe, but I was pretty happy relying on trueflation during the COVID era, when you felt like, the government was lying to you about inflation. And, they were relying, like, the government was lying to us about inflation to the upside, to the downside during COVID. So, like, it was, they were reporting 8% and it was actually 11%. And obviously, like, you can understand their incentive to lie when inflation is actually when inflation is actually 3% higher than what is being reported. But right now, trueflation is reading at like 2.54% in the US, and the US government's reported rate is 3%. So they're actually reporting inflation higher than what trueflation is reading it at. And again, for me, it's just like, it's funny because there's a lot of these people who are obsessed with inflation and just think like the government's just, it's like this conspiracy. It kind of is, right? Like, I get it. I understand like why people feel that way. Like, inflation is a very efficient way for the monetary system and the central bank and the government to basically tax people. Inflation is a tax, right? And it also redistributes wealth away from the middle class and poor and into the hands of the wealthy, because inflation pushes asset values up and devalues reduces the real value or relative value to inflation of the debt that they hold against those assets. But now it's the opposite, right? So now they're not lying about inflation being high. They're lying about inflation being lower than reported. I would say Canada and the US inflation rates are usually pretty solidly in tandem. So I think the Canada's inflation rate is actually lower than what's being reported. And I was happy to use truth to call the government liars during the pandemic and say inflation's way higher than what you're saying. So I have to rely on it because it was very reliable during that period of time, and say, okay, well, inflation is now 50 basis points lower than what's being reported. To me, all of this tells me that there's a greater risk of a recession and deflation than this stagflation or inflationary resurrection that a lot of people are talking about. And this most recent release from Statistics Canada on CPI confirms that. I think we're seeing trends being verified that price growth is slowing. Anyway, let me know what you think in the comments. I know there's a lot of inflation people here. I know there's a lot of stagflation people here. Probably going to use stagflation in like the clickbait, like thumbnail thing. Have to. But let me know what you think is going to happen. Are we going to see what's the most likely outcome of this, like recession and deflation? Is it stagflation or is it soft landing, right? Or are we going to see more inflation? Tell me what you think in the comments. Thanks a lot for taking the time to watch this video. It means a lot to me that you would take the time out of your day, and I'll see you again as soon as I can.